Why is investing so important? We're going to talk about that on the program and draw a contrast between what investing is versus saving versus, unfortunately, what a lot of folks are doing out there these days, which is trading. So we're going to talk about why you need to make sure you're focusing on the investing part of those three options. Plus, we'll talk about some of the financial bad habits that are out there and, more importantly, how you can overcome them. So welcome to Dollars and Cents this morning, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you here on the News Radio WFLA Orlando network, along with 96.9 The Game, home of the Bucks. I don't know about you, but I'm sure our listeners on 96.9 The Game are very excited to watch the Bucks in the NFC Championship game against the Green Bay Packers. That's going to be at Lambeau Field, about 20 degrees. So a little bit colder up there than it is down here in sunny Central Florida. Game time is 3 o'clock, I think. So I'm sure right after this program, we'll probably start launching into pregame and all that kind of stuff. So you've got much to look forward to on 96.9 The Game today. If you happen to be joining us on one of our social media channels, well, then that means you're listening to one of the top 25 financial planning podcasts on the World Wide Web. So be sure and check us out there. You can also subscribe to us on our YouTube channel at Nelson Financial Planning. Every week we make a video of this program and then put it up so you can kind of see what I look like, because radio doesn't afford you that same opportunity. Anyway, my name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan that provides peace of mind for the future along with superior investment results. So last week on the program, we talked a lot about some of the top 10 tax changes for this year. A lot of changes, a lot of them COVID related, with the ability to take distributions out of retirement accounts and not have to pay the 10% penalty and spread the tax liability out over 3 years. Also talked about the stimulus checks. If you've got one, or maybe you're due one, then your 2020 tax return is a way to sort of true up both of those checks. The check that was mailed out here at the beginning of January is actually a 2020 tax item. So we put up the top 10 tax changes on our website this past week. So if you're interested in downloading a copy of those, just go to our website at Nelson Financial Planning. If you're a client of the firm, then you already got your copy mailed to you a couple of weeks ago from our office. So make sure you check that out, because there's a lot of changes that have happened in a very short period of time. And those changes are having some ripple effects at the Internal Revenue Service, because while right now you're probably starting to get your tax documents, I looked through the mail yesterday and started to see 2 or 3 important tax documents stamped on the outside of the envelope, which means that, hey, there's a tax document inside there. And so start putting those in a separate pile. And a lot of those tax documents are going to be coming in over the course of the next week or two, as that would typically happen. The deadline of having everything in the mail by the end of January typically involves W-2s, investment tax documents, things like that. Most stuff should be received by the first week of February or thereabouts, which then gives you the opportunity to say, okay, great, I'm going to go ahead and file my tax return. Here at the office, we actually sent out our tax organizers about 10 days or so ago. So our clients that we do the tax preparation work for, they already have that. And so everything's kind of going along smoothly on the front end, if you will. But there are problems on the receiving end. There are problems at the IRS because, as we've talked about on previous episodes of the program, the pandemic really dealt the IRS a pretty tough blow. They don't have the technology. A lot of the technology that they have, unfortunately, is outdated, and so consequently they didn't have the ability to seamlessly move and work remotely. I mean, obviously you would want a lot of security when you're working remotely involving someone's tax return, and they just did not have that. So they fell behind. We've told you stories of how there were tractor trailers rented for the purposes of just simply storing the mail for the IRS because they were so overwhelmed. In fact, as of year end, there was still about 7 million unprocessed tax returns for the year 2019. So that's a lot behind, if you will. Most of those were paper filing, which again is one of the reasons why we encourage folks to file their tax return electronically. I understand that for a lot of folks that they're not quite comfortable or maybe not embracing the notion of filing stuff online or using technology to do that. Of course, that's one of the things that the pandemic sort of accelerated for all of us, of all age groups. We had no choice but to sort of embrace the ability to order things online or communicate through Zoom or any of those other types of platforms. So when you think of it also, if your tax preparer is using the right technology, then there certainly should be the ability to file that return in a highly secure manner. In fact, I would probably argue that with the right technology, it's way more secure than the old-fashioned way of just mailing that tax return in. So make sure this tax season that you kind of really think about that, because if you look at the pile of unprocessed tax returns, the vast majority of them are, in fact, paper returns. So the reality is that you take that backlog that's already happened, you toss in a lot of the tax changes that happen late in the year. Let's not forget the second stimulus check. That's a 2020 tax item. And the IRS has been further tasked this past week with, hey, you guys have to make sure and track down the roughly 8 million people that haven't gotten their stimulus check at all. So the IRS has got a lot of stuff going on. They had a backlog going on. Now they're tasked with new tasks, and also to make and incorporate all of the tax changes that happened last year, particularly there at the end of the year with that latest COVID stimulus bill. They have to modify the forms, and they have to create these forms that reflect all of these tax changes. And so the problem is that they're not ready. So they actually have pushed back the date of when they're going to start accepting returns to February the 12th. So a little bit later start date on their end. And I want to encourage folks, though, if they've got their tax documents and if they're ready to go, then get your return done, get it all the way finished, sign the 8879, which is the form that you need to sign to electronically file your return. And then, even though it may not be able to be filed on February the 5th or 6th or whenever you wind up getting it done, know that it will go immediately on February the 12th once the window opens and the IRS starts to accept tax returns. What hasn't been announced yet is an extension or a change to the April 15th deadline. If you recall, last year they extended the tax filing deadline all the way to July 15th. I don't believe we'll see that happen this year to that length of a period of time, but I wouldn't be surprised if maybe they try and add a couple of weeks on, maybe take it to the end of April, or maybe an extra 30 days, May 15th. I think they're going to have to, because they're getting such a late jump on it, and there's so many tax changes. And oh, by the way, there's still a pandemic raging, so not everybody is comfortable going out and about. And so at the end of the day, I would imagine that we might see a change on that. But don't count on it. It's not, certainly has not been something that has happened yet. So make sure that you get your tax stuff, you get organized on it, you be ready to go. The reality is, one of the things that we've done at the office, we started this actually last year, is we have the ability for all of our clients to sort of upload their tax documents, so they don't have to make that separate trip. They don't have to go out. They don't have to go into the office or anything like that. So it really kind of cuts down on the interaction, if you will. But particularly during a pandemic, that's something that folks obviously value. So if you've got the ability to sort of upload those documents and do that through a secure manner, then that's certainly a great way to do that and to get started and get going on the taxes. But understand that the old folks at the IRS are behind the 8 ball, so just be aware of what is going to happen, because they're not going to take your tax return before February 12th. Encourage you to get it done sooner than that, but still there's going to be a little bit of a waiting time on that. Anyway, we're going to take a break. When we come back from the break, we'll start the conversation about investing versus saving, coming up next here on the program Dollars and Cents. So why should you be investing today? We're going to talk about that in this segment of the program, and we're going to draw a contrast between what investing is versus saving versus trading. Three very different and distinct concepts, if you will. And so I think in the midst of a pandemic with uncertain headlines and things like that, people are maybe steering away from investing. And we want to take an opportunity to sort of talk about what investing is and get some of the fundamental concepts on the table and why it's so important to make sure that you're doing actual investing as a way to accumulate wealth over time. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Coming to you on News Radio WFA FLA Orlando, along with 96.9 The Game. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. My name, of course, Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan that provides you with peace of mind for the future. So I think there are three concepts that we need to sort of get on the table first in terms of what investing really is, and sort of contrast it first of all with the difference between sort of investing versus saving, and we'll throw in trading there as well. So investing and saving are two very different concepts. When you're saving money, you're putting it away in a secure fashion, using something like oftentimes a savings account or a CD, or maybe even your checking account or your money market. Savings would typically have easy access, no fluctuation. If you're doing it through a bank, there's an FDIC guarantee as well. So that's the concept behind saving. Saving is putting money away that you know you're going to need or potentially need over the course of the next 6 to 12 months. So sort of like that short-term emergency savings, those kinds of dollars would traditionally be referred to as savings. One of the things that we've talked about certainly in prior radio programs is the importance of, for example, having an emergency savings account. There's a reason it's called an emergency savings account and not an emergency investing account, because when it's an emergency, you want to know that the money is there, it's easy to access, and you can get it at any point in time. That's the notion of having a savings account. Investing, on the other hand, traditionally works out to own a slice of a business. I mean, that's the fundamental concept of what investing is. When you're an investor in a business, whether it's your own business or whether it's a big company like Microsoft, you in essence own a slice of that operation. Obviously, there's greater risk in that proposition, right? If you own your own business, there's certainly some risk of a lot more fluctuation than the money that's just sitting in the bank, along with owning a slice of, say, Microsoft or Amazon or what have you. So there's definitely sort of a risk-reward trade-off. And as you introduce that element of risk, which is an element that is in investing, then that really helps to sort of distinguish it between saving. So if you think of it, the importance of having both cannot be understated, of course, because you need to have an emergency savings, and then, of course, you need to make sure that you have a larger portion that is on the investing side of the equation. And I think this is where sort of people are getting a little tripped up these days, is that oftentimes folks come in and talk with us for the first time, and what we typically see is that it almost seems like they are doing great on the saving side, but not so well on the investing side. And by that we mean that if we see the vast majority of all of their assets sitting in a fixed account or a stable value or a money market, well, then you're saving. You're not really investing. And the reality is that you surely want to have some savings. Maybe that's $25,000, and depending upon where you are in terms of your total asset picture, maybe that's even upwards of $50,000. But you start getting above that, you really want to then make sure that your investing side is a factor of 8 to 10 times more than that. So if you're saving $25,000 or $50,000, your investing side should be maybe $500,000, and the investing side has got to be bigger. But in today's world, we often find that the savings piece is much, much greater than the investing piece. The other thing to consider is sort of investing is like gardening, right? If you think of it, you plant a tomato seed, right? It doesn't, the next day you don't get tomatoes, right? I mean, it takes time, it takes patience, and it takes regular attention, right? Time for that tomato to grow, time, patience in terms of making sure that it's ready to produce or on the line to getting production of actual tomatoes, and regular attention. You can't just plant it and be like, oh, okay, I'll have tomatoes in 90 days. No, you've got to water it, you've got to take care of it, you got to feed it. That's a lot like what investing is. It's not an instant gratification process, which is why we don't view, sort of all the trading stuff, to bring that concept into the mix, all the trading accounts that are getting established out there as really akin to investing. Those trading accounts where you're in and out, that's not really what investing is. Investing is about growth over time and having that patience. Think of it like that gardening analogy, where you don't have tomatoes when you plant a tomato seed. You wind up having those over a period of time. And then, of course, investing also requires a concept of the economic, an understanding of the economic concept of opportunity cost. And so what opportunity cost is, if you have $1 or $100 or whatever, there's an infinite amount of possibilities that you can spend that dollar on, right? You can go food or travel, well, maybe not travel right now, but any infinite amount of options that you can spend that dollar on. College, retirement, cars, whatever the case may be. So when you spend that money on whatever it is that you spend it on, that means that you can't spend it on anything else, right? So once you've spent that money, then you've got to make another dollar in order to get the next thing. So consider how you spend money, because there's always that opportunity cost. Once you spend that dollar, you can't spend that dollar on something else. You've got to go out and make another dollar in order to have another dollar to spend money on. So those are kind of the three key concepts about investing in and of itself. There's a difference between savings versus investing. Way too many people these days are more on the saving side rather than the investing side. And then on the flip extreme, way too many people are on the trading side rather than the investing side, witness with all of these different online trading accounts that have been opened over the course of the past 12 months. And then as with anything, investing takes patience. It takes regular consistency. It takes paying attention to it, and then understand the concept of opportunity cost. So then if you kind of think of those three concepts, then we shift to sort of the other three concepts that are out there that make investing as valuable as it is. So we talked a little bit about this in talking about investing versus saving. There's the concept of risk versus return, right? Investing typically has more risk, but it has higher potential for return. Historical averages on the investing side would put you at 8 to 10%. Historical averages on the saving side might put you at 1 or 2%. So understand that that's a pretty big difference between those rates of returns over time, which gets us directly to sort of the next concept about investing and why investing is so important. That is the magic of compound return. It's been called the eighth wonder of the world. I think Dave Ramsey is one of the ones that calls it and refers it to that. But what that means is that with compound growth and compound returns over time, so you start with a certain amount of money, and at the end of the year, if it's made a certain percent, then it grows by that certain percent. And then the next year, the growth is then not on the original amount of money that you started with, but rather on the original amount of money plus the growth it made in that year. So as you can imagine, that sort of continues to compound over time, and it accelerates the growth of the investing. So the analogy would be, consider the analogy of planting that tomato seed, right? So tomato seed, plant it over a long period of time, you ultimately get tomatoes. What's in a tomato? A lot more seeds. And that's a great analogy to what the power or the potential of the magic of compound returns that ultimately happens. It takes time to realize the effect of those compound returns, much like it takes time to grow a tomato, but then you got a tomato with a lot more seeds from that one seed that you started with. So that's a good analogy for the magic of what compound returns. And then, of course, there's multiple aspects of growth as an investor. You can have growth as dividends, through dividends. You can have growth as just straight appreciation. So those are sort of the three very unique concepts of investing, taking advantage of that risk-reward sort of trade-off, using the magic, not really magic, but it's the power of compound returns, and then getting those multiple aspects of growth. So hopefully we've given you something to kind of sort of think about in that segment, the difference between investing versus savings and some of the key concepts of why it's important to be an investor rather than be solely a saver. You need to sort of do both at the end of the day, but do investing a lot more than savings in order to accumulate wealth over time. With that, we'll take a break and come back after these messages here on Dollars and Cents. Welcome back to the program. We're going to talk on this segment about some of the financial habits that are really bad to have, and more importantly, how you might be able to overcome them. One of the biggest reasons why we see people not being able to accumulate enough wealth and enough assets over the time to be able to have an enjoyable retirement is that there's some common bad habits that unfortunately we all have, and it's important to know what they are, identify them first, and then look for ways to overcome them. So that's what we'll be doing in this segment of the program. So welcome back to the program here at Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're one of the top 25 financial planning podcasts on the World Wide Web, so be sure and check us out on any of our social media platform channels. You can also watch us here on video as well on our YouTube channel at Nelson Financial Planning. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life. Maybe talk to you about getting out of one of these bad habits we're going to talk about in the segment, because there's certainly a lot of those habits out there that oftentimes you don't necessarily really appreciate until perhaps it's too late. And of course, first and foremost on the list would have to be that many folks just simply don't save enough. The bad news is that if you're wanting to retire on Social Security, the average Social Security check these days is a little under $1,400 a month, $1,390 to be exact. So that's a tough way to cover expenses if you're retired, if you're relying solely on Social Security. So what's the solution there in order to avoid that? Well, chief among them is to make sure that you are using the options that are provided to you, most likely through your employer. Now, we know that there's some employers out there who don't offer retirement plans and things like that. For those, you can certainly do an IRA or a Roth IRA. You can set those up in any number of ways. Just get online and you'll find a host of options on that. But if you've got an employer who's offering a plan, they oftentimes will have a match as well. So that's free money that you certainly want to be able that you're doing to the maximum amount that at least, at the very minimum, to the maximum amount that they are offering that match. And then one of the other concepts to do is to increase the contributions that you're making to those plans on a regular basis each and every year. We've talked about this in prior programs, but to the extent that you're getting sort of a regular cost of living adjustment in your pay every year, then don't get used to that being a part of your paycheck. Instead, take that additional amount that you're getting and just simply increase the amount of your contribution to your employer's retirement plan by that same amount. So you won't really see the difference. It's not like it will come as less money in your paycheck because you're taking the amount of the increase and increasing your contributions accordingly. So that's a good way to try and avoid one of the worst habits, which is not saving enough. Another habit, of course, is this notion of having too much debt, particularly credit card debt. If you owe just $5,000 on a credit card and that interest rate is 15%, then the cost alone, the carry cost alone, is over $60 per month. So the solution there, and oftentimes people fall into credit card debt because they don't have emergency savings, or an emergency comes up and they're like, okay, I just got to use the credit card because I don't have the money to pay for it. So the notion of having an emergency savings account is so crucial. And one of the suggestions that we make to folks is, look, even a $2,500 emergency savings account is enough to sort of make the difference between at least getting over the hump versus ultimately falling down. And so to get $2,500 a month, if you think of it like this, it's $50 a month for a year, and then at the end of the year you'll have that $2,500 emergency savings. So the solution, to the extent you're trying to kind of avoid high interest rate credit card debt and taking on too much debt, is to make sure that you've got an emergency savings account. Similarly, we were talking about this in the last segment, understand the notion of opportunity cost. If you spend $1, right, that's $1 that you can't spend on anything else. And there's an infinite amount of ways in which to spend $1, but once you do, then you need another $1 to get the next thing. So understand that every single purchase then has two costs, not just the cost that you're paying for the item, but the cost of what that money could have done being used elsewhere. And so understanding the notion of opportunity cost really sort of requires folks to stop and evaluate how they're spending their money. And so the solution there, in order to overcome that habit, is to really start to try and budget and keep track of your expenses. In today's world, it's easier to do that than ever before. You used to have a pencil and a piece of paper and write it down. These days, you just take your handy dandy phone and you keep track of it through a variety of apps out there like Mint. And ultimately, by keeping track of those expenses, then you're able to at least identify where the problems are and then start to change those habits. Remember, we're talking about bad financial habits, right? It's not like you can change a habit overnight. It's going to take time, it's going to take consistency, and it takes work. But by tracking expenses and understanding this notion of opportunity cost, then that will help you identify where you can, in fact, make some changes in your life to improve how much you're able to save for the future. Next up on this list would be, don't be afraid to ask for help, right? And not just from the internet. The reality is, use a professional. If you're doing your taxes, use a professional there. If you're trying to put together an estate plan, you want to use a lawyer for that. Same thing when it comes to financial. Make sure that the person that you're using when it comes to your finances has some kind of a credential, whether it's certified financial planner or certified financial fiduciary, or whatever the case may be. Make sure they at least have some baseline level of expertise in the subject matter. Similarly, like on your tax side, make sure they're an IRS enrolled agent or a CPA or a lawyer. Make sure that they're actually a lawyer, that they pass the bar. So the notion of using a professional, there's certainly a lot of options out there, a lot of price range, but understand an expert is an expert for a reason, and they can certainly add a lot of expertise or a lot of knowledge into that conversation. So don't be afraid to seek help. And when you do, make sure you interview a variety of people, make sure you get quotes on the cost, and make sure that they've got that in appropriate expertise for what it is that they're looking for. Another option, another bad habit, if you will, is that far too often people spend way too much time trying to keep up with the Joneses. And I think this is one of the many problems that social media creates, is that far too often we kind of look at what other people are doing, and I've never seen really a post on social media that talks about, like, we didn't take a vacation this year and we didn't travel and we didn't go out to eat. No, it's pictures of people going out to eat or traveling or doing whatever, and it all looks great. But that's a very one-sided picture, and you have to be careful with that. So the solution there is really kind of to try and take what you see your neighbors doing on social media and sort of take that with a little bit of a grain of salt, right? Looks are in fact deceiving. They always have been, they always will be. Live your life and find out what attracts you to doing the things that you do. You do you, as my kids say. And ultimately, I think that's a very good suggestion for folks, particularly when it comes to their finances, because I think all too often we really get far too engrossed in what others are doing and start that comparative game. And the reality is that you're really only seeing half the picture. When you see someone drive up in the shiny new car, the neighbor next door driving up in the shiny new car, you don't see the note they just signed that requires a $600 a month payment. You don't see that. No one's putting up their the note that they borrowed the car that they used to buy the car in the first place. Instead, they're putting up a pretty picture of the car with a bow, kind of thing. So just be aware. Looks can be deceiving, and they don't tell all of the story. We're going to take a break. When we come back from the break, we're going to kind of continue this conversation about some of these bad habits that are out there. Got a few more that we want to kind of get on the table, get people thinking about, hey, wait a minute, if you're doing one of these habits, perhaps you need to also figure out a way to break it. So we'll come with the solutions on those as well. Coming up next here on Dollars and Cents. So we're talking about some of the bad financial habits that folks have that ultimately probably want to break out of unless you want to have a pretty lean retirement. So in the last segment, we talked about the notion of not saving enough. We talked about running up credit card debt and some of the solutions you can do to try and avoid that. We got a few more that we're going to share with you on this segment of the program as well. And so one of the biggest issues here that we see is the notion of staying consistent, right? That's one of those concepts that when you hear it, it's like, oh, okay, so staying consistent, that means I just don't, have to do anything that will fundamentally alter or change the path that I am on. And the problem is that that's one of those ones that always sounds easier to do than in fact it is in practice. But if you're consistent, and particularly when it comes to investing, then there's certainly an infinite amount of studies out there that sort of confirm that by being consistent with your investments is one of the best strategies to be able to do. Now, don't misunderstand me. That's not saying that you shouldn't check on them along the way, right? We were talking about earlier in the program about this notion of investing being similar to gardening, right? You don't just plant it and forget it. You pay attention to it, you water it, you feed it, you prune it, you do all of those kinds of things. Well, investing does require that. So don't confuse being consistent when it comes to your investments, this notion of that you're going to ignore them. There has to be that ongoing maintenance, that ongoing review of exactly what it is that you have in terms of those invested dollars, doing things like rebalancing, doing things like looking at the individual company allocation to make sure that you're properly diversified. All of those are part of that process. So don't confuse being consistent with ignoring. Investing certainly requires you to be paying attention to it along the way, but when we talk about consistency, what we're talking about is not shifting your overall allocation dramatically in light of whatever the headlines are. Certainly, there's been a lot of headlines of late where it would be easy to get very distracted and say, well, wait a minute, because of this headline or because of this election or because of this pandemic, I'm going to shift all of my assets. I'm going to shift my entire investing strategy in a way to respond to those headlines. That's the perfect example of where you want to be consistent and not do that. That inconsistency will, in fact, cost you a tremendous amount. Another one is eating out too often, right? That's easy. But it's not just lunch, right? It's the coffee. It's the snacks. If you buy a Starbucks at $5 a day, right? 5 days a week, you did 5 days a week, $5 a day, then that's going to cost you about $1,300 for the year. If meanwhile you make a cup of coffee at home, cup of coffee at home, right here in the mug, then that's only going to be like 25 cents. So coffee still, in fact, does cost a quarter. Okay, if you're familiar with the old expression that and a quarter will buy you a cup of coffee. Well, quarter still buys you a cup of coffee, except it's at your house. So make sure that you're doing coffee at the house, and then that way you can save about $100 a month over what you would be if you were not doing that at your house. This next one is a tough one, because I think as parents and as friends, we often struggle with this one. And this is this notion that maybe you're just being too nice. And what we're talking about there is this notion of you've got family, you've got friends, and certainly everybody goes through periods of time where they need help. But at some point, you have to sort of draw the line. And lots of people will say, oh, I want to help, fully pay for my kids' college education. I want to help them purchase their first home or something along those lines. And that's fine. But the bottom line is make sure that you can afford that from a financial perspective, and that you're not going to undermine your own retirement. So be careful. It's a tricky one, but try not to be too nice. And then, of course, lastly, as we kind of wrap on up and get on out of here for this week's program, it's procrastination, right? If you put off things, then ultimately you don't have the ability over time to achieve those compound growths. Remember, there's always going to be some headlines or something like that makes it easy to push things off. The longer you put off starting investing and starting with and having these good habits, then the harder it's going to be for you to accumulate real wealth over time. So there you have it, some of the bad habits that are out there, and hopefully some ways in which to break them. If you've got one of these habits and need help breaking them, don't hesitate to give us a call here at the office this week. My name is Joel Garris. I'm with Nelson Financial Planning. This is Dollars and Cents, and we're out of here. Have a great Sunday. Go Bucks!